Hello Singapore and Asia Pacific. At S&B, we're excited to revisit Singapore and work with traders interested in learning the U.S. equities market. I'm Mike Bellafiore, author of the trading classic One Good Trade and partner at PhillipCapital, a proprietary trading firm that sits in downtown Manhattan. Ask me one-on-one questions about the markets. Learn the best trading setups from our experienced traders. Finally, take control of your trading decisions. Trading is the best job in the world. Please come and take our training class in Singapore and learn how the pros do it. I look forward to meeting you soon.
Welcome to Phillip Futures Market Watch. My name is Joyce Liu, Investment Analyst with Phillip Futures. The Chinese economy has been showing undeniable signs of slowing down. The official manufacturing PMI collected by the National Bureau of Statistics of China, which tracks a basket of larger companies, skirted dangerously above the 50 mark. The HSBC China PMI, which tracks a different basket of smaller companies, remained below the 50 mark for a third consecutive month in June. A reading above 50 indicates expansion, while a reading below 50 indicates contraction. In addition, Chinese exports in June contracted by 3.1% against expectations of a 4% expansion by a Reuters poll. This is the worst performance since financial crisis in 2009. But Chinese policymakers show little intention of using monetary easy policies to stimulate growth as they did in previous economic slumps. Their reluctance to ease and stimulate growth is not without basis. In order to successfully maneuver from externally reliant exports and FDI-led growth towards internally sustainable consumption-led growth, a slowdown in manufacturing and exports has to be tolerated. So what does that mean for investors like us? We recommend longing USD CNH futures as well as shorting base metal futures, specifically copper, aluminum and nickel. CNH represents offshore renminbi, which investors outside mainland China can invest in. Since July 2005, when China switched to a managed float policy against the US dollar, the dollar-yuan exchange rate has been almost one-directional. US dollar has been depreciating against Chinese yuan, except during the peak of the financial crisis when the Chinese central bank repegged Chinese yuan to the dollar. In other words, Chinese yuan has been appreciating against US dollar. However, the course of USD CNH may be set for reversal in the months to come, as we foresee the yuan depreciating against the dollar due to three factors: expected slowdown in economic growth, expected slowdown in liquidity, and expected slowdown in US bond buying stimulus. First, expected slowdown in economic growth. As mentioned in the beginning, manufacturing and exports have shown obvious signs of slowing down and is likely to remain in contraction or close to contraction in the months to come. And as Premier Li Keqiang firmly asserts, the slowdown is expected and will be tolerated. Second, expected slowdown in liquidity. Capital inflow to China has been slowing. In fact, since late May, when the prospect of Federal Reserve cutting back on easy monetary policy has been raised, we are witnessing a general fund outflow from emerging markets, including China. Third, expected slowdown in US bond buying stimulus. The time will come when Federal Reserve officially inks down in their FOMC meeting a schedule for tapering stimulus. And when that happens, perhaps as soon as later this year, investors are likely to rally the dollar against most other currencies, including the Chinese yuan. As such, we foresee possible depreciation of the yuan against the dollar and recommend longing USD CNH futures for mid-term investment. Also impacted by China's slowing growth are the prices of industrial metals. China has been the largest consumer of industrial metals in the last decade or so because of property development, infrastructure construction, and consumer electronic sales boom, along with the double-digit economic growth in the world's most populated nation. But the tides are now changing. Various rounds of property cooling measures are slowing property development, and fixed asset investments are growing at a slower rate, reducing the demand for industrial metals. In addition, supply of most base metals, in particular copper, aluminium and nickel, are in large excesses due to lagged responses to extended periods of underestimation of demand and elevated prices. Producers also refuse to step down production for fear of losing market share. Therefore, we recommend shorting futures for copper, aluminium and nickel for mid-term investments. For more information on the risks and returns of investing in currency and metals futures, please approach any representative from Phillip Futures for further discussion. Thank you, and please stay tuned for more Market Watch videos.